I'm Steven D'Addario, and welcome to ValueGap. Today, I want to take some time and talk about one of my favorite companies, CROCS. Now, if you're unaware or live a bit under a bubble, CROCS has been making plastic shoes, what they call clogs, for the better part of 2 decades now. At the end of the first decade in the mid-2010s, the brand faltered a bit. They overexpanded their SKU count, demand dropped a bit, and they brought in their new CEO, who's currently there, Andrew Reese, in about 2018, and the brand's been growing ever since. They recently added the Gibbets platform a few years ago to enhance creativity of each shoe and essentially allow you to put little toys on each shoe, which is a pretty good personalization angle. And they use it to spur creative designs with auxiliary brands. But nevertheless, let's get right into it, looking at CROCS as a good value investment. When I look at any investment, I like to look at 3 specific things. The first thing I like to look at is the durability of the brand. How durable are the cash flows? Because ultimately, when you're looking at valuation, that is the number one consideration in terms of being able to provide a return on your investment. The second thing I'm looking at are current bear arguments against the stock. So I want to understand why people are selling off this stock and try to quantify that risk. And then is that risk properly priced in, or is that risk even real? And then last but certainly not least, want to take this all into account and look at the valuation of the firm to see if we're buying the company at a potential discount. We want to be buying $1 for 50 cents or $1 for less than $1, as ultimately that is what is going to produce our outperformance over time. So the first argument I want to get into is the durability of the CROCS brand revenue. And for this, we're going to focus on the main brand. I'm not going to focus on the Hey Dude acquisition, which they made in 21 for $2.5 billion to diversify their revenue stream. And we'll get into that when we talk about more bear arguments. But right now, we're just talking about the durability of the CROCS brand as a whole, and I think the current PE warrants that discussion to be framed as such. I see, and many others see, and I would argue that this is relatively factual at this point, but CROCS are almost the Kleenex of clogs, right? Plastic shoes, they are the Kleenex of plastic shoes. When you think about CROCS, you think about rubber plastic shoes that are comfortable. Well, that's a pretty big brand category that they have immense brand control and brand recognition in that category. That translates to the ability to sell shoes for a slightly higher price. Like, let's take a little thought experiment. If you walk into the store and you see CROCS knockoffs or plastic knockoffs for $30, but you can buy CROCS shoes for $35, $40 because that's the average selling price of the brand, what are you going to buy? Well, you're probably going to buy CROCS because it has the brand recognition, positive experiences associated with the brand, in addition to the Gibbets platform that allows you to personalize them. It's something unique. So when I'm looking at plastic shoes, I'm thinking, well, CROCS are like the tissue that should help them bridge that durability long term. Furthermore, they've existed for a couple of decades. Yes, they've gone through a little rut in the mid-2010s, but they brought in a new CEO and they've been growing ever since. And the fact that they've been around for that long should speak to the durability of the revenue in and of itself. And lastly, but certainly not least, we look at their business strategy. Like I said, through their Gibbets platform, they're able to bring on many brand collaborations where they change the silhouette up slightly of their core clog and they add a couple of these charms or Gibbets to the shoe to make them truly personalized and unique. Well, the benefit of this model is that these runs are very limited release, which means that there's constant demand being created and spurred through these promotional events, which again should bode very well for long-term demand creation. One of the things about why we care so much about the durability of revenue is through research that we've conducted and labeled the result of it, the Stephen curve, which essentially breaks down the amount of firm value that is generated throughout time. So is the majority of firm value derived from near-term cash flows, or is the majority of firm value derived far into the future? And what the Stephen curve analysis shows is that the overwhelming majority of firm value is derived far into the future. So just to put this a bit more quantitative, sort of in terms of this discussion, is that for an average growing American firm that is around mid 3% CAGR, trading at roughly around a 15 PE, well, that company needs to operate for about 15 years, and only about 7 of that 15 PE is accounted for in terms of value being accreted to the actual firm itself. So when we're looking at CROCS, and CROCS is trading at a PE roughly around 7, we need revenues to be durable for roughly 15 years for our payback period, and then anything after that is just pure alpha. And again, I think the prior arguments and realizations on the brand help support that result. I just wanted to tie a bit of that qualitative discussion into the quantitative reality of investments and why we care about revenue durability so much. The next thing we're going to be talking about are the bear arguments against the stock. So we want to understand the other side's points and theses better than they themselves do. So the first that we kind of already touched on is the faddish nature of the demand behind CROCS. Well, I think we've sort of dispelled that notion a little bit in the sense that they're operating business strategies meant to continue spurring demand. Retail's in a little bit of a bear market right now, which is sort of putting pressure on discretionary spend as a whole. And then they have the decade-long track record to sort of give you a reason that they're going to be operating for the next decade. The next bear argument, which is, I guess, the bigger one, is related to the 2022 acquisition of HeyDude for $2.5 billion. Now, this acquisition was meant to diversify the CROCS brand in face of slowing revenue growth after COVID had sort of elapsed, and diversify the source for the future to give more durable, sort of diversified growth. Well, how did this work out? Well, revenue is up and earnings are up relative to when they were consolidated into the brand, but in 24, CROCS realized about a 13% decrease in HeyDude revenue. So in a nutshell, what does this mean? Well, this is reflecting quite poorly on the capital allocation skills of the company in terms of it seems like they overpaid for a brand that doesn't really have a moat. Now, the company is taking the brand back to its roots, looking back at what it does best and trying to ignite their icons, the Wendy and the Wally silhouettes. And so far, results are quite positive. DTC growth is up 7% in the most recent quarter, which is outstanding. And as wholesale continues to normalize, as it seemed they pushed too much volume on to the wholesale channel, that might bode for a nice little tailwind into the future. But at the end of the day, the brand is trading at 7 PE. Simulations that have been run by ValueGap internally and sort of back of the napkin valuation models indicate that even if the HeyDude revenue dissipates completely, there still exists a value gap on the CROCS stock as a whole, and it still remains a good investment. You roughly go to about a 9-10 PE ex HeyDude, which is still slightly lower, in our opinion, at the very least, of what the fair range of what CROCS should be trading at. And last, but certainly not least, let's take a look at the valuation behind the CROCS brand itself. So we're going to head over to ValueGap here and type in CROCS. And what we'll see is that CROCS has a very, very large value gap, above our rough rule of thumb, which is around the 20% range. And this takes into account very low revenue growth, a very high cost of capital, and EBIT margins that, quite frankly, are already being achieved. So in terms of what's being priced into this stock, we have a very little growth. And again, where's this growth going to come from? Well, it's coming from international growth. The brand is quite healthy. It's growing double digits internationally and even single digits in the US itself. So when you look at this growth forecast, the brand can easily do this. In addition, the cost of capital is probably larger than it needs to be. CROCS is an established brand. It's probably closer to a 9% cost of capital in terms of the entire enterprise. Because remember, this cost of capital is for the enterprise. And this would imply a cost of equity or a required rate of return for equity holders in the 13-14% range, which again, if you can hold CROCS and earn 13-14% return, everybody on planet Earth should be holding CROCS, because with all due respect, that's about almost double what the S&P is projected to do long term. But nevertheless, the valuation is incredibly conservative, right? Even with these low growth targets, we have a very, very robust value gap that helps us, again, sleep at night with respect to the valuation behind the stock. The stock is earning a yield on its earnings of around 16%. And that's really, really ridiculous, considering the fact that it's relatively capital light, and that translates into the free cash flow yield ex stock-based compensation in and around 14%. Let me just sort of say that again so that you understand what that means. If the company never increases its earnings ever and just pays out its capital, which they have a history and they are committed to capital redistribution to shareholders, you should yield roughly 14% on your investments should their earnings not decline. Even if their earnings decline 50%, you're still holding roughly a 7% cash flow yield. That is an immense value gap insofar as the risk-reward asymmetry that is present in the current stock. If we come back down here and we lower our cost of capital, maybe we think growth is going to ignite a little bit and margins come down a little bit to reflect some sort of slight margin pressure on the brand, which is, again, being really, really bearish. Let's say their tax rate is roughly higher at 21%, which is the marginal tax rate. Even at this, let's go ahead and run the simulation, runs thousands of different simulations of CROCS's cash flows to arrive at what the company is worth today in terms of its intrinsic value. And this is all done in real time. It's an incredibly cool feature of the ValueGap platform. While we're waiting, we can even see the PE of the brand is incredibly low. I mean, we're trading at a 6 times near-term PE. And if you look at the analyst forecasts, we have revenue that's projected to continue increasing despite flat net income. Well, that's, again, pretty good asymmetry there, considering the fact that their margins have been relatively stable at around the 24-25% mark for a long time. I mean, look at these stable margins. I mean, to be honest, I don't understand why the stock is trading like this, and it's just such a brain dead easy opportunity, to be quite honest, and it's why we're so bullish on it for ValueGap. Anyways, coming back to our custom simulation, even with these new sort of parameter targets, we still have a simulated price roughly around 140. That's a value gap of roughly 40%. That's ridiculous. That's a ridiculous value gap considering the sort of the operating success of the company. So we're really bullish long-term CROCS. We like the valuation. We like that it essentially implies zero growth. Anyways, we really like this stock and can't really understand why it's trading the way it is, and we really like it from a value gap perspective. So anyways, if you enjoyed content like this, make sure to like and subscribe and stay tuned for more value gap content.